Welcome to the Retirement Guide Podcast. I'm your host, George Jameson, owner of Capital Wealth Group, a flat fee only advisory firm. Whether you're nearing retirement or already retired, join me each week as we explore the world of retirement planning and equip you with the knowledge and tools you need for a successful retirement. So let's get started. Today's episode is part one of 3 episodes on how to plan for taxes in retirement. If you're age 50 or above and want to reduce your taxes in retirement, this 3-part series is for you. Today, I'll go over basic taxes and what to watch out for. First, let's talk about cash flow planning in retirement. When you think about income and taxes in retirement, a lot changes. Most go from getting a steady paycheck and accumulating assets to having to generate income from your assets. This can be complex, and you don't want to mess it up. That's why you need a detailed retirement plan that includes taxes. There are many big decisions that must be made, and you'll want to get it right the first time. In retirement, you have 2 main categories of income. First, you have the more reliable income sources, such as Social Security, pensions, income annuities, and possibly rental income or a part-time job for a few years. And all of these flow into your tax returns. Then you have what I call a portfolio paycheck. This is what you have control over. When to take distributions, how much to take out, how much do you need, and what accounts you take from first to optimize your total taxes in retirement for your unique situation. All of these flow into your tax return, but they don't all get taxed equally. For a successful, tax-efficient retirement, you need to have a comprehensive plan that takes into account taxes. This plan should include understanding all the income sources available to you, the deductions you may be eligible for, and how to adjust to any changes that may come your way. By being proactive and planning ahead, you can minimize your taxes and maximize your retirement income. If you look at the ordinary income tax brackets for 2023, the more you earn, the more you pay Uncle Sam. Unfortunately, when you retire, you will obviously still have to pay taxes. In retirement, ordinary income includes pensions, up to 85% of your Social Security, short-term capital gains, unqualified dividends, interest income from bonds, CDs, savings accounts, the earnings from annuity distributions, and maybe even a part-time job or self-employment income. When we talk about someone in the 22% marginal tax rate, it doesn't mean they pay 22% on all their income. For married filing jointly, 0 to $22,000 is taxed at just 10%. The next section will be taxed at 12% and so on. So not all of your income will be taxed at your marginal rate. The more accurate number to figure out is your effective tax rate. Next, you have qualified dividends and long-term capital gains rates. Long-term means something you have owned for at least 1 year. These are taxed at 0%, 15%, or up to 20%, depending on your income. If you're able to keep your income at the lowest level, you may not have to pay any capital gains tax. In general, while you're still working, if you're in the higher tax bracket, it may make sense to make traditional deductible contributions to your 401k. However, if you're in a lower tax bracket, you may want to consider making Roth IRA or Roth 401k contributions instead. It's important to consider whether your taxes will be lower or higher in retirement than they are now. If you believe they'll be lower, traditional contributions may be the better option. On the other hand, if you think they'll be higher in retirement, Roth 401k contributions may be the better choice. If you are unsure whether your taxes will be higher or lower in retirement, which many of us are, you may want to consider allocating at least some savings to traditional 401ks, at least some savings to Roth IRAs or Roth 401ks, and some to taxable accounts as well. And now let's look at the tax hierarchy and tax withholdings. You basically have 3 different categories. The first category is taxed as ordinary income, such as IRA withdrawals, 401k withdrawals, corporate bonds, and CDs. Social Security is also taxed as ordinary income, but only up to 85% is taxed. And for most, only at the federal level. Only 9 states may tax your Social Security starting in 2024. Note, if you work part-time, your pay is also taxed at ordinary income. The second category is called alternate rate. It includes long-term capital gains rates and qualified dividends. Qualified dividends and long-term cap rates are taxed at 0, 15, or 20%, depending on your income level and tax filing status. Ordinary, non-qualified dividends and short-term cap rates are taxed at your marginal income rate, which is determined by your taxable income. You also have depreciation recapture, which is about 25%. The third category is no taxes. These include withdrawals from Roth IRAs, Roth 401ks, interest from municipal bonds, which are tax-free at the federal level and possibly at the state level. You also have qualified health savings account withdrawals, which are also not taxable. Now let's look at the underpayment penalty for safe harbor rules. As you transition into retirement, you may need to understand the safe harbor rules and figure out if you need to set up tax withholding or pay quarterly estimated taxes. These rules are set up by the IRS, and as long as you meet these rules, you will not be penalized. If your federal income tax withholding, plus any estimated taxes you paid, amounts to at least 90% of the total tax you will owe for this tax year, or at least 100% of the total tax on your previous year's return, you most likely will not need to make estimated tax payments. One quick note, if you're married filing jointly and your AGI is over $150,000, or you're single and your AGI is over $75,000, you'll need to pay 110% versus the 100% from your previous year's return. Usually when you are working, your income is fairly predictable for most of us. However, in retirement, your income can vary dramatically from year to year. And here's the issue. Tax preparers often are historians. They're often looking backwards, which is not ideal for tax planning. So what to do? If already in retirement or about to retire, it's important to estimate your taxable income. This will help you decide how much to withhold from your IRAs, 401ks, etc. for taxes, and if you may need to make quarterly tax estimates. Since there are often changes to your taxable income from year to year in retirement, we suggest estimating it annually and creating a longer-term tax projection to help make decisions that can lower your overall taxes for many years, leading to potentially substantial savings. So first, estimate your taxable income. Second, calculate what you think you will owe for federal and state. You can use an online tax calculator or have your financial advisor or possibly your CPA do it for you. And third, if necessary, set up the proper withholdings and or quarterly tax payments. So that wraps up today's episode. And next week, we'll talk about the Retirement Opportunity Zone and go into much more detail about the different tax saving strategies and how to plan for them. I hope everyone has a great day. Thank you for tuning in to this episode of the Retirement Guide. If you enjoyed this episode, please subscribe and leave a 5-star review to help others discover the show. For questions, ideas, or discuss your retirement plan, reach out to me, George Jameson, at Capital Wealth Group. Visit our website at capitalwealthplan.com to learn more. Thank you for listening. Stay tuned for more insightful retirement planning in future episodes. And now for the disclaimer. The information discussed in this podcast is for general explanations and education only. It is not tax, legal, or investment advice. Before considering acting on any information heard here, first consult with your tax, legal, or investment advisor. Thank you and have a great day.